Hello elevators. Welcome back to another video from Elevate Forex Institute. In this video we'll cover how you can trade synthetic indices. In our previous video, we shared what synthetic indices are. If you haven't seen that yet, watch that video first and then come back and watch this tutorial. You will be able to find a link in the description. While you're at it, don't forget to like and subscribe so as not to miss out on any future videos. We will really appreciate it so that YouTube can recommend this video to more people just like you. Thanks again, let's begin. How do you trade synthetic indices? You might be wondering, why would you trade these synthetic indices like Forex when you can just trade the real thing, i.e. currency pairs? Trading synthetic indices can be seen as training in understanding real markets as a first step before moving on to trading more complex instruments such as Forex and stock indices. Synthetic indices are simulated trading instruments that mimic or reflect the behavior of real financial markets. Synthetic indices are typically simulated trading instruments that move based on an underlying asset, usually based on the stock market and other financial markets. Synthetic indices are programmed to mimic real-world and market movements and rely on a cryptographically secure random number generator that is regularly verified by an independent third party to ensure fairness. They have constant volatility. Here, by volatility we mean the degree of price fluctuation over time. They are free from market risk and liquidity risk and are not affected by natural phenomena. Volatility indices mimic or replicate the behavior of financial markets, but because they are not like currencies, they are not affected by fundamental factors such as announcements of higher interest rates. To explain the opposite, synthetic indices are like regular trading instruments with ever-present volatility that keeps the market moving 24 hours a day, 7 days a week without any interruption by natural events or news. Market movement does not depend on fundamental indicators. The main drivers of the Forex markets are the fundamentals that have pushed the market to achieve a certain trend. But since synthetic indices are independent of fundamentals, there is no sudden risk. Launch or volatility news based on fundamental issues. Considering the many advantages of trading in two markets, there is no doubt that synthetic indices are better than Forex. It can be argued that synthetic trading is much better than currency trading, especially since foreign exchange markets that close on the weekend are heavily influenced by mundane events. Synthetic trading offers many advantages over traditional currency pairs and financial indices. If you are a retail Forex trader and want to pretend to be an institutional trader, you can technically trade synthetic currency pairs too. An Mount 5 account will allow you to trade synthetic currencies, Forex and cryptocurrencies. DMT5 also has various plugins that allow you to automate trading. DMT5 provides access to a wide range of professional trading tools. DMT5 allows traders to access 44 analytical objects, 38 technical indicators, and unlimited charts in 21 timeframes. 44 analysis objects can be customized to suit your trading strategy. Range break, jump index, boom and crash index trading, and step index are also available for trading. Here you'll find everything you need to know about trading synthetic indices, including volatility and range gap indices, daily reset indices, peak indices, ladder indices, and booms and busts. Jump indices are indices that correspond to simulated markets with volatility of 10%, 25%, 50%, 75%, and 100%. Bullish and bearish market indices usually reset daily at 12 midnight GMT. Bull and bear markets usually reset daily at midnight GMT. Since they are not open 24/7 like the Forex market, you need to find the right time to take a position in the index market. If you are a beginner, you may want to avoid trading during high volatility hours. Know the best time to trade the specific index you want to trade. The volatility index of the best time to trade 75. For example, you can open a short, sell, trade on a volatility index in 2 hours, while a simultaneous up, buy, trade on the same index was calculated in 2 minutes. These few examples show that you can successfully trade volatility indices using price action. Getting started is an advantage because you can learn about volatility indices and how to trade them without risking your own money. You can trade synthetic indices on Mount 5, X, Trader, Go, etc. It is important to open a free demo account and start practicing your strategy before opening a real account. To be precise, in order to trade volatility 75, crash, boom, step, or any other artificial index, you need a Mount 5 synthetic index account. You will have the lowest possible spread and the highest possible leverage to trade any index from the synthetic list. You can trade synthetic indices on Mount 5, options and auto trading using broker-provided options trading bot, which you can modify according to your strategy. When it comes to trading synthetic /volatile indices, you only have one broker offering them. One of the most frequently asked questions is that there are many tools for traders to trade Forex and the recent emergence of cryptocurrencies, so why would a trader trade synthetic indices on Forex and crypto? This is due to the high earning potential of synthetic indices, which has caught the attention of most traders, but as with any trading asset, entering the market without proper knowledge is a recipe for skipping a trading account. In order to make the trades that institutional traders need, they need to create a synthetic pair. You should also consider that different indices trade at different times, depending on the specific exchange. These volatility indices can also be used in binary options trading, but we will focus on how to trade them in the same way we trade in the Forex market. Like the Forex market, synthetic indices can be tested on a demo account. You can choose between different synthetic markets with high or low risk characteristics according to your risk appetite. Forex is based on the movements and relative strengths of countries' actual currencies, but composite indices are computer-generated random numbers that cannot be manipulated by any fundamental or political aspect. Thanks for watching. Hope you enjoyed the video. If you have any questions, please leave them in the comments section below, and don't forget to like, subscribe, and switch on the bell notification button to be alerted when the next tutorial is published. Elevate Forex Institute, taking you higher.